Good morning, everybody. Welcome back to the Pension Geek studio this morning, where we are going to be talking financial well-being. So just so that we know that you're all out there, we've got all the Pension Geeks here behind the scenes. Give them all a thumbs up. Woo! Hello. They're all sitting there, ready for your questions coming in this morning. So what is financial well-being about? Well, last year, you might be amazed at this. I was just chatting to the geeks about it. In the UK, we took 21.8 million sick days off, and that was because of stress, anxiety, depression, and loads of that stress and anxiety is due to financial worries, money worries, sticking our head in the sand, not knowing what to do. So in my quest to help people be a little bit more financially happy, we're going to go through a few top tips this morning. So we are going to be touching on budgeting and using money pots, giving your money a goal to do something with. Then we're going to be looking at overdrafts and what's happening there, because there's been some changes that you definitely need to know about. Then we're going to go on, and if anyone saw my session yesterday, Pension or Pizza, we did touch on this. It's about your credit rating, how to get your credit score up. Then we're going to be talking about a few things like the mortgage holidays that you can take at the moment, and I'm just going to be pointing out how long you've got to do that. And then of course, it wouldn't be the same. We couldn't end without chatting through pensions. So they're the 5 things that we're going to cover this morning. Now, as usual, I'm going to be chatting for about 10 to 15 minutes on those subjects, but please ask your questions. This is what this session is all about. It's about you guys getting what you need out of it. And of course, we need to mention the Pension Geek glasses. For those people that are sending in the best questions or the best series of questions, these are going to be awarded at the end of the week. So make sure you get those in. Okay, so one more cheer behind the scenes, make sure everything's working. Woo! Okay, off we go then, let's start. So I'm going to start on budgeting and money pots. So now whenever we are dealing with our money, are you one of these people where your money comes in at the end of the month and then before you know it, you think, where's it gone? I've got nothing left. I'm now going to have to use my overdraft. I'm going to have to use my credit cards. Well, the key to this is budgeting. And there are loads of tools out there we can use. There are tools on the Pension Geek website, on the Pension Awareness Day site, on Better With Money site. That's what I do when I'm not being an honorary geek. I run Better With Money, giving financial education. So you can get tools on those sites. You can either get paper-based ones where you print them off and you write down all of your essential spend, all of your debts that you've got coming out, all of that fun stuff like what you spend on takeaways or going out with your friends. You look at everything that you've got coming in a month, you write down everything that's going out in the month, and then you see what the difference is and see what you've got left over, if anything, which you've got to spend to the end of the month. Now, if you do that and you think, right, brilliant, after everything that goes out, I've got £500 left for the month. What is the best way of dealing with that? Well, I wanted to give you a little tip because most of the UK banks now, wherever you've got your bank account, most of them have got something called money pots. So I bank with Barclays. They've got Ping It jars. You've got Starling that use spaces. I think you've got Revolut and Monzo, they use vaults and things like that. So have a look at your bank account. Now what that means is, I'll just chat you through it. So let's say I've got £500 left at the end of the month. Now, I know that I've got my husband's 50th coming up, and I know that is not going to be a cheap month for me. So all this year, after I had my pay, after all the mortgage has gone out, it's like, right, I'm going to put £50 a month into my Barclays Ping It app. So I go in there and I just say, right, I'm going to set up a little jar. It's called Phil's 50th. It goes in. Now, it's not going out of my bank account, it's staying within it, it's just that I can't see it anymore. It's kind of hidden in that little jar to make sure that I don't spend it. Of course, if I get to the end of the month and I'm running low, I can just transfer it back in instantly. But if you haven't used these pots or jars before, get onto your bank account, see what you can do. It saves you from setting up separate bank accounts and having different logins. It's all done with the one account. So that is the first tip. Use your money pots or your jars that you've got within your bank account. Number 2, we're going to stick with bank accounts, and I'm going to talk about overdrafts. Now, I don't know if you're aware, but back at the 6th of April this year, there was a change in the overdraft legislation. So the Finance Conduct Authority said, right, we want banks to stop charging the daily rates for overdrafts, and everybody's got to go to a single interest charge instead. Now, the idea behind this was that all the banks went into competition and it would drive down prices. That didn't happen at all. What actually happened was all the banks said, oh, we think we will now charge all around 40% of an interest rate for overdrafts, which is massive. So if you are somebody that is using kind of £600 overdraft month on month on month, you're probably going to be a lot worse off under the new regulations. But then, of course, what happened? Coronavirus kicked in. And so what the FCA said was, actually, we need to make sure that people aren't financially disadvantaged. So all of the banks actually chose to put in a £500 interest-free overdraft over the last 3 months to help people get through this period. So you might not have noticed actually the change to those overdraft fees because that £500 interest free has been put in there. But my point to you this morning is those £500 interest free overdrafts are now coming to an end. A lot of banks have already ended that. But you've actually got until the 31st of October, if you feel you still need that, to go back to your bank and ask them to do that. Some of them are not charging that 40% yet, some of them are only charging 20%, but if you don't know, check out, because what I don't want you to do is be paying a lot higher charges for using that overdraft than you've actually paid in the past. Right, so we've done money pots, we've done overdrafts. Let's get on to number 3. Now, credit ratings, it's inevitable in life that we are going to have to borrow some money at some point, and it's not a bad thing. Some of that borrowing is good. Something like a mortgage where the interest rate is really low, it helps us to get the house that we want. But do you know how you are viewed as a borrower? When a bank says, oh, right, am I going to lend to this person? How do you know that they're going to do that? Well, the thing to do is to find out what your credit score is. Now, 90% of people in the UK do not look at their credit score regularly. And if you're saying, Sarah, how do I do that? Johnny, do you know what your credit score is?
No, I'm going to do it after this.
Good. Right, I'm going to... Oh, apparently Rick the cameraman has got an excellent credit score. Right, so, and I loved this yesterday when I spoke about it because people were literally going onto the apps as I was talking. There are loads of apps out there that will give you your credit score practically instantly. You need to sign up to them. So there are things like a ClearScore, Credit Karma. Credit Karma is the one that I use. You've got Equifax, lots of different ones. So just search it. How do I find my credit score? You'll come up with the apps. Download the app, put in your details, and it will tell you whether you've got an excellent credit rating, a good one, needs improving, or really poor. And obviously the idea is that you get it up, you get it into that good rating so that you know that when you're going to borrow some money, that bank is going to say, oh, they're a good person to lend money to, and then you get much more choice of mortgages, more choice of credit cards, all of those sorts of things. We can go into more detail in that on the question and answer, but if you haven't done it now, get that app downloaded, type in, let me know, have you got an excellent credit score, have you got a good credit score? That would be brilliant. So that is tip number 3, find out what your credit score is. Number 4, I want to talk about mortgage holidays. So, it's a really sad fact that we know lots and lots of people over the last few months have been worse off. Maybe you've been furloughed, some people have lost their jobs, some people are just taking reduced hours and salaries are going down. And because of that, there were special measures put in on mortgages and everybody could have asked for a 3-month mortgage holiday if you are struggling to pay your mortgage month on month. And I know about 2 million people have chosen to do that. Now, when you get to the end of that 3-month period, you can actually ask for another one if you want to. But the reason I'm bringing it up today is there is a deadline to ask for this, and the deadline is the 31st of October this year. So if you haven't already done it, go on, ask your provider if you need to, if you're financially struggling. Don't do if you don't need to, because what's going to happen is even if you don't pay your mortgage, you get that payment holiday for 3 months, you're still going to have the interest racking up on that. So at the end of that, your mortgage company should write to you and they will tell you what your options are. And it might well be that you just extend your mortgage period to cover that time that you've had off. It might be that your payments are slightly higher. But the great thing about it is that it won't affect your credit rating. All of the mortgage providers have said that it won't show on your credit score that you've taken that mortgage holiday. But please be careful, do not cancel your direct debits, because if you cancel the direct debit, you will be seen as having defaulted on that mortgage. Just let the mortgage provider stop it at their end. So you've got until the 31st of October to do that, guys, if you really need to, if you feel that you're struggling and that you need some time off paying the mortgage. You can also do that for credit cards, car finance, insurance premiums. There's a whole host of things that you can take holidays on at the moment up until the 31st of October. So take a look at that. And then, of course, the last thing, we couldn't leave the session or me chatting without talking about
Pensions.
We love pensions. So it's just going to be a little bit of a recap of everything that you would have heard. So why do we need a pension? We need a pension because at some time we're going to want to stop working. And where are we going to get the income from? We need to save a pot of money to make sure that we can draw on that when we stop working to carry on having the life and the standard of living that we have today. Now, in the UK, and this was a great move forward by the government, if you are age 22 or over and you work for an employer, they will have to automatically enrol you into the workplace pension that they provide. So you put some money in, your employer puts some money in, it goes into your pot, it gets invested, you get compound growth on that. And the idea is that by the time you get to retirement, you've got a lovely pot of money which you can then start drawing an income from to support your lifestyle. And of course, whatever you save is going to be on top of the state pension that we are entitled to as long as we've paid at least 10 years worth of national insurance. So you get your state pension and you get any pension that you've saved up for. And the really, really great stuff about pensions is it is still the most tax efficient way of saving in the UK. So whenever you put money in, you get tax relief at your highest rate. So if you're a higher rate taxpayer, that's 40%. If you're at basic rate, that's 20%. But also, once you've saved up that pot, whatever you and your employer have put in, when you come to retirement, you can take up to 25% of that tax-free. It is the most tax-efficient way of saving. Now, if any of you joined my session last night, it was the pizza or pension. Basically, what I was saying is, on average, we spend about £30 a month each in the UK on takeaway pizza. What you could do is think about, oh, what happens if I invest that in my pension instead? And I think if my memory serves me correctly, if you start doing that when you're young, if you start at age 22 and put an extra £30 in, by the time you get to 65, you could have an extra pot from that £30 a month of about £30,000 to do whatever you want with. Personally, I would go on a lot of nice holidays, but there's lots that you can do with that. But the real key here was to get £30 into your pension, because you get full tax relief, even if you're a basic rate taxpayer, it only costs you £24. So you get the £30 into your pension, only costs you £24. You've got £6 left over. You can still buy a couple of pizzas. From Aldi, I got 2 amazing pizzas yesterday for £6. So that was the premise. So if you have paid off all your debt, if you've got a bit of money to save, if you can afford to leave it there until you're at least 55, because that's the earliest age at which you can access pensions at the moment, think about, should I put a little bit extra into my pension? It's the most tax efficient way of saving. Right, there you go. They were my 5 tips. So we looked at money pots, using those on your bank account. We looked at overdrafts, be really careful with the charges. We looked at how to get your credit score and how to boost your credit rating. We looked at mortgage holidays, and we've looked at pensions. So what we're going to do now, guys, you probably know the drill by now. We're going to just put a slide up. Johnny's going to come and join me on stage, and then we're going to go Q&A. So please bring in all your questions. We'd love to chat to you about all of those subjects. See you in a minute. We're back. Johnny's joined me on stage.
Hello.
Hello.
Wonderful. I was sitting backstage. Great tips. I was going to do my credit score live on air, but I couldn't get the app downloaded in time. But after this, I'm going to be doing it. I really am.
Perfect.
I was going to ask a question here about, and it might be unrelated, so bring me back on topic or not. about 7-8 years ago, I had some money on my credit card that built up, and I never told anyone about it, and it was causing me lots of stress and worry. And it wasn't, well, it was about £1,000 on my credit card, and to me that was a lot at the time. And it just kept going. I couldn't break the cycle of getting it down. And how Rachel, my girlfriend at the time, or still is, I kept it from her, not maliciously or anything, but I just felt a bit uncomfortable speaking about it to Rachel because I thought she'd, I don't know, think I wasn't good with money. But I spoke to her, and she actually helped me over a few months or half a year, get that credit card bill down. A credit card's good, are they bad? And is there any tips you would give to anyone, if you can, if they were in my situation, how they can maybe fix that? Because that was causing me some really... I didn't have any days off work, but I couldn't sleep properly and I couldn't stop thinking about it.
Yeah.
Is there any tips you could give me?
Yeah, and do you know what, Johnny? You are definitely not alone. Because if you think about people in the UK, as soon as you get to 18, you're given a credit card.
That's great.
Whether you're a student or whether you started work, and how many people are actually taught how to use a credit card?
Wow.
No. So what I say to you, and we'll break this down, is that credit cards can be good if they are used properly. And the reason they can be good is because they can actually used properly, which means that, let's say you put your food shopping on each month, as long as you pay it off in full at the end of every month, then actually you're building up your credit rating. Right. You're being seen as a good borrower. So as long as you're using it responsibly, and you're not paying high charges on it, you're not letting it rack up, you're paying it off in full, then it could be a good thing. And actually I've said to both I've got 2 girls at uni, and I've positively encouraged them, which they were not expecting, to get a credit card to put their shopping on as long as they've paid it off. Now, what happens is, unfortunately, people aren't taught how to use them. They don't know that you have to pay it off by the certain time each month, and then what happens is, bit like you, and you think, I can go out and I can go on holiday and all of that, and suddenly before you know it, you have a big debt. And the problem with that is that if you don't pay off the amount in full, even if you pay off a little bit, you start racking up interest based on the full amount that you've got there. Even if you've paid a bit off, you still rack up interest on the full amount that you're there, and that keeps going up. So if that is you, and if you were in that situation, there's a few things you can do. I mean, the first thing I say is, if you've got any savings at the moment, use savings to pay off debt. Because savings rates are really low at the moment, because the base interest rate is now down at 0.1. If you've got money saved, the likelihood is you're getting no more than 1% interest, and you could be paying high charges on your credit cards up to sort of 20%, if you've got an overdraft up to 40%. It's a no-brainer. Use the savings to pay off the credit card. I'm assuming you didn't have savings to do that, because you're just living for your means day on day on day.
I didn't. But if we check, I'm going to just jump in it. If I checked my credit score now, that was maybe 10 years ago, let's say. Is my credit score still going to be bad because of that? Because surely it'll have impacted it.
It's normally the last 6 years that show on your credit score. Brilliant. So if that was 10 years ago and you've been sensible ever since, then that should be all right. But I'm just going to give you...
to be sensible. But I feel better with my finances now, so I've managed to get in a better place.
I'm just going to do a couple of tips as to, if you find yourself with large credit card debt, what to do. So the first thing to do is to see whether you can transfer that balance to a 0% deal. There are lots of credit cards out there who, if you transfer money from one credit card to another credit card, say you won't need to pay any interest with us for a year, 18 months. And there are, during coronavirus, some of those deals went away. They are starting to come back. There are some out there. So that would be the best thing to do, to look at whether you can transfer it, and then that gives you a longer amount of time to pay it off. And then start putting aside money monthly to pay it off, to do that. If you've got an overdraft and you're starting to pay that off, you can also use some of the 0% credit card deals where they transfer cash into your bank account. It will pay off the overdraft, reduce your overdraft back down so that you can't go into it again, and then you've got a longer period of time over to which to pay it off.
Sarah, that was really, I feel bad. This is more of a personal
This is an
one-to-one. So, but if that was relevant to you guys, give us a thumbs up. We'll get to your questions now, and I apologise if I've taken up some of your time. Okay, so the first one we've got by Emily. Does checking your credit score have an impact on it?
That is a brilliant question, Emily. I do get asked that a lot. And I think, there was definitely, I don't know if that used to be the case, but it certainly isn't the case now. If you personally are checking your credit score via one of the apps, it will not affect your score at all. What might affect, or what can be seen on your credit file, is if you apply for finance. So let's say you applied for a mortgage, that mortgage company would check your credit file, and then it would show on your credit file that you have applied for that finance. And the reason it shows on there is because lenders want to make sure that you are not going to 10 different providers asking for 10 different credit cards. They all give you that credit card at the same time, and then suddenly you've got way more credit to use than you could ever pay back. So it's really to protect you. But no, you checking your own credit score is not going to have an impact. It's not going to go down because of that.
Great question. And I was thinking that too, but no, really good question. We've got one here from, what we've got now? James, should I close a credit card when I've paid them off?
Okay, another great question. So your credit score, sorry, I'm going to backtrack and I will get to that in a moment. Your credit score is made up of lots of different parts. They lots of different things. So for example, if you are not paying off your credit cards month on month, or you miss a payment, you could see your credit score fall by as much as 35%. But another factor is how much credit you are actually utilising. And you will get the best credit score. So let's say you've got £1,000 that you are able to use on a credit card. You will have the best score if you are using less than 30% of that. So if you're only using £300. So if you look across all your credit cards and think, actually, I've got lots of credit cards here, lots of debt on it. If you manage to pay one off, it could well be in your best interest so that you don't keep racking up more and more credit and more debt to close that one down. Because the other thing that mortgage companies, lenders look at is how much credit you've got available to you. Because they might say, because a mortgage lender is not going to want to give you a mortgage and then go, oh, actually, he's got 3 credit cards, he could put 10 grand on all of them. If he does that, and he's still got a mortgage to pay, he might end up defaulting on his mortgage. So yes, only have the credit cards that you really need, but a good mix of finance is good. If you've got a mortgage, if you've got a credit card, if you've got some finance on your phone, as long as you're paying it all off monthly, that mixture of credit is all going to be adding to your score. It's good stuff.
Brilliant. We've got a question behind the camera. Or?
Is your credit score just personal, or does it take into account your business credit cards?
Okay, so it is personal.
Right. Sorry, Rick might not have heard. So let's just reiterate Rick's message or question he had from behind the stage.
So Rick, the cameraman, said, is it just based on your personal financial circumstances, or if you've got a business, is it on that as well? It takes into account your personal circumstances, but be careful because you might be financially connected to somebody else. So say, for example, you're married, you've got a joint bank account, any activity on that bank account, or let's say a joint credit card, if your partner was using that credit card, and it's a joint credit card, they didn't pay it off and it was their responsibility to do that, you miss a payment, that is going to affect your own credit score. But it's around your personal finances.
Okay, Rick, thanks for that one. I've just got one quick one here in the chat. S has just checked the credit score. 99 out of 99.
Wow, that is amazing. You must be doing a lot of good stuff. A lot of good stuff. Amazing.
Brilliant. One thing I'm going to say quickly. Do you know the reason why I got my credit card?
No, tell me.
So I think I was in a good place with my money for a bit. My mum and dad told me, they were like, credit cards are the work of the devil. Do not get one. So I never did. So I must have been about 23, 24. And I was looking about getting a mortgage to buy my first house. It never happened, but I was looking at trying to get a mortgage for that. And I went to see a couple of people to try and get a mortgage, and they said, Jonathan, you need to go get a credit card so I can rack up some information and get an understanding of your spending habits.
Absolutely.
So that's why, and that was my first introduction to credit cards. So really, my mum and dad should have had a bit more of an open conversation, or I should have taken it on myself to find out a bit more about credit cards. And I think there's more information about this. I mean, blooming it. I'm 30, I'd say 30, am I 36? 36.
Still a whippersnapper.
Yeah,
That is still young.
It was 10, 12 years ago, my math's not great, when that happened, or maybe longer. But there's better information out there now. So is there more information out there for people to understand that credit cards can be good if used correctly? Is there more information?
Yeah, absolutely. There's loads of great articles and things. I mean, I tend to look at, the Money and Pension Service. Yep. They have great stuff about credit cards and saving and debt all on their website. You've got Money Saving Expert as well. I mean, if you look on there, if you're thinking, actually, what I've heard today means that I am going to go and get a credit card and I am going to use it sensibly. I am going to use it to build up my credit score. But actually, what's the best one to get? Are there any that are offering cash back? Are there any that are going to offer me some freebies? Then look on the Money Saving Expert website. Every day they update all the different offers that are available on the credit cards. So go there, have a look, and see what you can find.
My sound's not great. Rick's in here just checking my sound. While Rick's doing that, could I ask, okay, I think we did answer it, Sarah. Is it Sarah? Yeah, I think it's Sarah. How long does it take to get your credit rating to improve from bad to good? You did mention it to me, but let's just reiterate it.
Well, it will depend on how quickly you can action some of the things. I mean, one of the things that can improve your chances of getting a mortgage and your credit score is just registering to vote. And you can do that on the gov.uk website. But if you make some very small changes, like reduce the number of credit cards that you have, if you start paying off your monthly payments in full, you can see very quickly your score starting to rise. I mean, my daughter got her credit card a year ago, and at the time it was sort of teetering on the needs improving to good. I mean, she was only 19. She's now got that into the good category, and she's teetering on the excellent. If you have had something in the past, like Johnny did, where you racked up some credit card debt, if you've missed a payment, then that will stay on your credit file for up to 6 years, and it could impact your score for that long. But obviously, the more history you have of paying off your cards every month, the better your score will start to become. So you can make an instant change, but some of them will take a little bit longer.
Brilliant. We've got one here. Christian, what is your view of using ISA to save? Christine, sorry. I'm dyslexic, so I do apologise.
Right, Christine. There's lots of ways to save money, and it's going to totally depend on when you need that money and for what. So if you're going to need the money in the short term, in the next few months, then actually something like a bank account, an easy access savings account might be best for you. If you can save that money for a little bit of time, for the medium term, let's say up to 5 years, maybe you're saving for a car or a big holiday, then an ISA can be a really great way to save. You can open an ISA and you can put up to £20,000 a year into it as an adult. And the real Brucey bonus with the ISA is that any investment return that you get or investment growth is totally tax-free. And then anything that you save, when you decide to take it out for whatever you're going to use it for, you don't pay any tax on the proceeds that are coming out. So that is better than just saving it into a bank account. So I would say if you can afford to invest the money for the medium term, then ISAs are a really good way to go. Absolutely. And can I mention here, can I do the extra one? If you are looking to save for your first home, and you are between the ages of 18 and 39, then please check out the Lifetime ISA. So this was introduced by the government back in 2017, and it is specifically designed to help you get on the housing ladder quicker. So if you're between those ages, you put money in, you put up to £4,000 a year in, and the real star of the show is that government will add a 25% bonus onto that £4,000 that you put in. If you only put £1,000 in, you'll get £250, which is 25% of that. If you get £4,000 in, they'll add 1,000. The only thing I'd say about it is if you have got the Lifetime ISA and you get the government bonus, there are only two things you can do with that money without losing that bonus. One is to use it for your first home. The other one is you could actually leave the money in there until you're 60 and use it to top up your pension, top up your retirement. If you take it out for any other reason, you will be penalised normally by 25%, but that penalty has been reduced down to 20% until March next year because of coronavirus and people struggling and might needing to get the money out, but it'll be going back up to 25%. So yeah, great question on ISAs. Brilliant. I could talk forever on ISAs, but certainly check them out.
We've got one here from Laura.
Did you just get that one? Sorry, did you get that one from Emily, which said, can you repeat the bit you said about using your card well? Did you say use only 30% of your credit card?
Yes, Emily, thank you for that question. It was talking about using your credit cards and sort of your credit utilisation. So what I said was, if you use around 30% or less of your total credit limit, you will get a better score. Your credit score will go up. If you are maxing out your credit limits, you may find, temporarily you have a dip in your score. If you manage to pay it off and you get it back down to 30% month on month, then your score will go up.
I've got one quickly on that. So if I didn't have a credit card, my credit score could be still used on my phone each month if I'm paying monthly on that and I miss a payment. Does that affect my credit score?
Absolutely, yes.
It's not just a credit card. You don't have to have a credit card to get a credit score. It could be anything.
It could be anything where you borrow money. Okay. Now, I've had people before and they said, I thought I was being really great. I've got all of my money in I've got all my money in a bank account. I pay everything up front. I save to buy my phone and I save to buy my car, and I don't have a credit card. I thought I was doing really well. Downloaded the credit score, really, really bad credit score. But the reason for that is nobody knows what kind of borrower you are. You're not building up any credit history. So yeah, it doesn't have to be a credit card, Johnny. Okay. It could be any kind of finance, from car finance to phone finance, other loans, bank loans, things like that.
And if people doing the credit score now assess 99 out of 99, perfect. But what about if someone goes on and it isn't that good? I mean, for me, it could be some shocking news right now. It's not something to be really sad about. Maybe it's a wake-up call to think about, right, what I need to be doing. Is that
what I need to do? And just be aware of it.
And you can change it.
Yeah, that you can change it. So there are 5 things. Let me just recap on those, and I might be looking at my notes a little bit.
You can look at your notes as you get the right information.
There are 5 things that you need to do to improve your credit score. The first one is pay off your credit cards, or at least the minimum, month on month. Just paying £1 above the minimum payment is going to help your credit score to go up. So if you're one of these people that forgets to pay, set up a standing order, set up the direct debit, make sure that those payments, at least the minimum, goes out month on month, so that you don't it's not detrimental to your score. The next thing, which Emily talked about, was your credit utilisation. So if you've got £1,000 credit limit, try and make sure that you're only using 30% or less of your credit limit to target your very best score. The next thing is that the lenders really like it if you've had something like a bank account for a really long time, because it shows that they can see your financial history on that. So for example, I have still got the bank account that I set up when I was 11. I have got other accounts that I use as well, but I know that is helping my credit score because I've had that account for a really long time.
Like me, I've actually got my mum and dad banked with Barclays and put me in there, and I'm still with the same.
Still there. So that's
Yeah.
going to be a good point on your score because you've had that long credit length.
I've got some good points in.
So sometimes, you know, people say you should switch and you should get the deals and you should get the free travel cards and all the rest of it. Yes, you can, but just be aware that might actually be negatively affecting your credit score if you keep changing your accounts all the time. The other one is your credit mix. So the more types of credit you've had and the more you can prove that you responsibly pay all of them off, the better. So, for example, I have got a credit card. I have now got car finance very recently, and I've also got mobile phone card. But that's going to be adding in my favour as long as I'm paying it off. And the last one is if you are looking, say, for a relatively large loan, because you're going to have a large purchase, or you're going to be looking for a mortgage, don't apply for too much new credit in the 6 months leading up to that. And the big no-nos on your credit score are using overdrafts and payday loans. I mean, I don't think we've mentioned them yet, but those payday loans are those very high interest short-term loans.
I've only heard negative things about them, but I don't know much about them to comment. But
yeah,
are they yeah.
I mean, they can be like 3,000% interest. Over, you know, and they lend it to you over a very short period of time to get you through to the next payday.
Wow.
They are seen as a big no on your credit score. So, you know, see if there's other things that you can do instead. You might be able to phone your bank and say, please, can I have an interest-free overdraft? And make sure you don't go above that, you know, rather than trying to take loans. You might be able to get a 0% credit card and use some of the money on that and then pay it off over the period of time. But if you can avoid payday loans, avoid them at all costs, because that is really going to badly affect your credit score.
That was great coming on to that, because yeah, good to know. I've heard a lot about them, but not enough about them. Okay, so I've got Laura here. She said, I'm a bit confused about how much money you can take from your fund tax-free. I thought it was £12,000, but Sarah just said, I don't know what you said here, it was 25% of the total fund. Could you clarify? So can you clarify?
So Laura, you're bringing us back to pensions. Thank you very much.
Pensions!
Pensions!
Rock and roll!
We love pensions. Okay, so there are two things that you need to know about tax and pensions. So, well, let's start. When you put money into a pension, you get tax relief at your highest rate. You're building up that pot. You want that to be, so your employer's paying in and you're paying in. And then when you get to retirement, whatever that pot is, you can take 25% of the total value of that fund out as a tax-free cash sum if you want to do whatever you want with it, to go on holiday, to buy a new car. So that is where the 25% comes from. That is your 25% of the total pot that you save up as tax-free cash. Now, I think what you're referring to is the tax-free allowance that we get every single year, both when we're employed and when we're retired, which means that we can earn a certain amount each year without paying any tax. And at the moment, for the average person in the UK, that is £12,500 a year. So if you've listened to any of James's sessions, any of the pension sessions, what you would have heard is that, let's say you get the full state pension, so that's £9,100 a year. And let's say that you got an extra, let's say 6,000 that you'd saved up, and you're taking £6,000 a year extra from the personal pension pot that you've saved up. So you have got in total there, can you do the maths?
I can't do maths.
No, right. 15,100 coming in. Of that, you are not going to pay any tax at all on £12,500. And then the remaining between the 12,500 and the 15,100, you will pay basic tax on. So I think hopefully that's answered the question, Emily. Two different things. You've got your tax-free cash sum, and then you've got the amount that you can have as an income every year that you don't pay tax on, and that's 12,500 in this tax year.
Oh, I think that was Laura, by the way.
Oh, that was Laura.
Yeah.
Did I say Emily?
You did.
Sorry.
Well, Laura, tell us yes or no
Thank
in
you.
there. I was going to say as well, if you've missed any of James's webinars, and especially Pensions in a Nutshell, can I get a yay for that?
Woohoo!
It's on, James actually
James has just joined us.
He's in the back of the studio. You can go on the Pension Awareness Day website in the video library and catch up with all the webinars you may have missed. James did touch on this within his webinar, especially Pensions in a Nutshell, so check that out. Next thing, I see there's one from Joel. Joel's had one in there for quite a bit and we haven't managed to answer that. So I've heard about salary sacrifice mentioned in some of the other webinars, which is James's, which you can go back. Well, it's probably watched them. How can I check if I'm on salary sacrifice?
Right, okay, yeah, so again, this is a pensions question. So some employers take advantage of this tax facility, and basically what they say is, rather than us pay you some money for your salary, and then we deduct your pension contribution once we've paid it to you and pay it in, why don't we do it a different way round? Why don't we, before we even pay you your salary, deduct your pension contribution and put it straight into your pension as an extra employer contribution. Now, the advantage of this, basically you are sacrificing a bit of your salary before you're even paid it for it to go straight into your pension. And the advantages are that that means that you get full tax relief through your pay packet because basically your salary comes down, and you also pay no national insurance at all because you're not even paid that salary, so you can't pay national insurance on it. So that is the reason why employers tend to opt to do salary sacrifice. Now normally, and correct me if I'm wrong James, employers tend to do this for everybody across the scheme. Occasionally an employer might allow you to opt out of salary sacrifice if they felt that, one, your salary is getting down towards the minimum wage because you can't sacrifice your salary below that, or for personal reasons, you might not want to do that. I mean, when it was first introduced years ago, I was actually doing some pension induction sessions and talking to people about it, and said, you know, your scheme, it's salary sacrifice, that's great, it means you're going to save the national insurance, and someone said, but my national insurance goes towards the NHS, and I want to pay towards that, so I'm going to opt out of the scheme. And that was her personal choice, but most employers make the decision as to whether the scheme is in salary sacrifice or not.
And Joel could potentially go to his employer and say, look, have we got salary sacrifice here, and am I in the...
Yeah, sorry, that was the other part of the question, wasn't it? How will I find out? Yes. Have a look at your pension scheme booklet, and that should say it. If it doesn't say that, ask your employer, and they'll be able to tell you whether it's on a salary sacrifice basis.
Called any other things?
Oh.
It can also be called salary, yes. So that was Rach saying, is it called anything else? Sometimes it's called salary exchange, sometimes it's called smart, sometimes it's salary sacrifice. So take a look at the terminology, see whether you've got that. James is waving at me. Yes, James.
Also look at your pay slip, because if it's not salary sacrifice, it will be under tax and NI, but if it is salary sacrifice, it will be under your gross pay, normally as a bracketed number.
Brilliant.
We might have to return that.
James was saying, also look at your pay slip, because if it's pretty much on the left-hand side, so basically it's taken off, you've got your salary and then it's taken off and there's no national insurance and no tax associated with it, it's probably salary sacrifice. If it's on the right-hand side of your pay slip and you get paid first and then the deduction happens, then the likelihood is that it's not. Thank you, James. Awesome.
Second part to Joel's question is, where we know, sorry, is it the employer's decision to opt in or out of the scheme?
Yes, normally they do it at a scheme-wide level,
okay,
and they will make that decision.
Sorry,
That's right.
Okay, shall we go to Bill? Bill's just done his credit score online.
Well done, Bill.
While we're doing this on an app, Credit Karma. Is it Credit Karma?
Credit Karma.
Yeah,
Yep. Used to be called Noddle,
Noddle.
or Noodle. So if anybody's ever, it was Noddle. So Noddle is now Credit Karma, in case you're wondering.
Okay. He's given his score there. Let's just flick down. He's saying he pays his bills on time, and he does everything right. But why it is lower?
Why is he not at the maximum?
Yeah.
So, Bill, it could be for a whole host of reasons. Now, you have told us here that you're a US citizen, you're not registered to vote in the UK. And that means that actually they do some financial checks around your address and things. So if you're not registered to vote, that might be reducing your, because you can't. That's no criticism. That might just be bringing your score down a little bit. Sometimes, I've given you sort of the 5 main things that affect. Sometimes it is very difficult to know. Sometimes they're a little bit out of sync. So actually they're taking your credit score now based on finances about a month ago. I mean, it could just be that, you know, you're not using credit enough. You might only have a credit card. You might not have any other type. So that credit mix, you're not proving to them that you can deal with lots of different repayments from lots of different types of credit. I don't know if you've got a mortgage. If you've got a mortgage, that can sometimes bump up, you know, and you're paying that regularly, that can sometimes bump up your credit score. So yeah, normally when you go onto something like Credit Karma, there is a bit that you can click on to say, what do I need to take account of? What can I do that is going to help me to push up my credit score? And they often start feeding through kind of nudge facility type, this is what you need to do if you want to get your credit rating up. So take a look at the app. But thanks for that. Brilliant.
Phil has just said, my longest held bank account doesn't appear on my credit report. Can I get that changed?
Yes, you can. So contact, there's normally a place that says, if you think there is anything wrong with my credit file, report it here. So click on that, see if you can get that put on. And actually, that's a really good point. I mean, not just about saying, oh, actually my bank account's missing, but looking at your credit score and looking at your credit file regularly, it means you can also keep track of whether there's any fraudulent activity. You know, if someone's opening a credit card in your name that you don't know about, and I know you were talking about scams, weren't you, the other day? Yeah. So that is another, you know, as well as keeping track of your credit score, it's a really important thing to do to make sure that nothing's happening financially behind the scenes that you don't know about.
Good tip.
Yep.
Bill said thank you to that. Laura also
no problem, Bill.
said thank you. It made sense to her earlier when we answered her question. Alex, I've checked my credit rating. The app says that at the moment I've not got any credit limit on the account and I need to ask my credit limits to be improved for this. What does this mean? This is putting you on the spot here.
No, it's because you say, look, is it because I don't own a credit card and I'm not using an overdraft? Yeah, that's right, Alex. So when you apply for a credit card, what they tend to do is look at your financial circumstances and then put in a credit limit that they feel that if you used all of it, you have the means by which to pay it back. So, you know, normally, for example, on a graduate coming out might get a £500 credit limit. And then it shows on their credit file that they've got a £500 credit limit, and actually month on month they're using £100, £200. Because you haven't got a credit card, you have no credit limits, and therefore that's what we were talking about earlier. You know, yes, credit cards can be bad if you don't pay them off, but they can also be good used sensibly because it helps you to get a good score. So yes, that will be you answered your own question, but brilliant. Thank you for bringing that to our attention.
Hannah, does having a credit card increase your credit score? I've never had a credit card. I have a mortgage and my score was lower than I thought.
Yes, Hannah, it can increase your credit score if you have a credit card and you use it. And I'm going to keep harping back to this, if you use it responsibly. If you can use it every month and pay it off in full, that is the absolute best way to bring up your credit score. So I don't know if you were on earlier, but I was saying for my kids that are at uni, what they do now is they put their monthly shopping on there. They don't spend that much, say 20 quid a week. So they're putting £80 a week onto their credit card. Every time they spend money on food, they move money out of their bank account into their money pot that we spoke about earlier. So they know, and then at the end of the month, they'll have £80 in their money pot, and then they transfer it straight into their credit card. So they are paying it off in full each month, and that is helping them to get their credit score up so that when they apply for a mortgage, hopefully it's be as good as it can be. So even though you've got a mortgage, which is a great tick for having a credit score, if you're paying that off, then yes, having a credit card as well will definitely help you to boost it up.
Got another question here. My ClearScore account keeps telling me that I need to open a credit card and register to vote, but I already do both.
Hello, Carolina. I think you were on yesterday.
Oh, yep.
Yeah, she was. Lovely to have some questions in from you.
A regular guest.
Yes, absolutely. We like that. It could be. I mean, I don't know how long ago you opened your credit card and you registered to vote, because, as I say, there is a time delay between what your credit score picks up and what you're actually doing. If you feel that it's not picking it up correctly, then again, go into I think there might be something wrong with this, because you can appeal to then have that put on, and LinkedIn, which you might see brings your credit score up.
Brilliant. Guys, can you see any questions that we've made?
Jen sent one in about salary sacrifice. You said, do you still have to receive the minimum wage after the pension contribution has been taken?
Yes, so the question there was, if you are in salary sacrifice, after that pension contribution's taken, do you still then, after that, need to be earning the minimum wage? And the answer is absolutely yes. You cannot sacrifice your salary below the national minimum wage, which might be a reason why, if you're in that situation, your employer's got salary sacrifice, you might need to opt out if you can't go down that route.
Brilliant. Yes, it is me.
Yay, thank you for joining again.
No, she must be a fan of Sarah's. Or mine, I think it might be
I was
Sarah's.
going to say, I think it might be you, Johnny.
No, I don't think so. Right, okay. Guys.
Phil says, do you have any views on car finance?
I was going to ask this, Phil.
What's the best way of financing a car?
Before we get on to this, I was going to ask a question before this, right? Say if I want to finance a car, and I've got bad credit rating or a score, will they not let me finance a car? Is that something that it might...
There is a strong possibility that if your score isn't good,
Yeah.
because what they do is they take all your details. I mean, I've just done it, and I had to put in all my details. I had to give them what my annual salary was.
Okay.
They can check my credit score.
Yeah.
If you do all of that, they're well within their rights to come back and say, actually, we don't think this is affordable for you, or because we've looked at your credit file and can see that you're not a good payer backer.
Yeah.
I think I've made that word up. But
Good
you know, if you
payer
pay a backer,
That could be in James's slang.
you pay a backer. If you're not a good payer backer, then
Chewbacca,
yes,
like
they
Star Wars.
could well turn around and say, sorry, we are declining you for that finance. And actually, if that will also go on your credit file, if you've applied for something and you've then got declined, unfortunately, that will then be detrimental to your credit score as well. But in terms of, I mean, yeah, there are lots of different ways, aren't there? There's leasing, there's car finance. And what I have found actually recently is that the car finance is still charging higher interest rates than some of the bank loans at the moment. For example, I think the one that I was looking at was about a 6% interest rate on car finance, whereas if I go to my bank at the moment, I can get like a 3% loan. So it is well worth, you know, although finance is a great way to allow you to get the car that you want, do have a look first to see if there are other methods that you might be able to get a loan from somebody else at a lower rate and then pay it back to them. But it changes month on month. You know, sometimes the bank loans are better, sometimes the car finance is better. You know, I know somebody who got car finance on 2%, which was brilliant. So I'm not going to give a definitive answer. I would just say it's really key to see what the interest rate is that they are going to charge you, because obviously the lower the rate, the better it's going to be.
Can I ask another question there? So say is it like a 3 to 5 lease or a finance deal you get on cars now? Is that kind of how they work? I'm not too sure, but is that...
Yeah, so I mean, I've put a deposit down on a car, and then I'm going to pay mine back over 4 years. Okay. But then at the end of that 4 years, I've then got a payment at the end if I want to keep it.
So with that, say if I chose not to get the 7% one for the finance deal from the car place, and I said, oh great, I can go to my bank, it's 3%. Yeah. In that time of me paying it back, could the bank ramp up is it a fixed rate or does it change? What's that?
Normally they would fix the rate at the point at which you take it.
Okay.
So with Barclays, I've had a Barclays loan before, and that's the trick actually, is finding
Yeah.
the time at which rates are pretty low. Now rates are going to be around the lowest that they've been at the moment because that base rate interest rate is really low. It went down to 0.1% on the 19th of March. So as a whole, borrowing money at the moment is cheaper than it probably was a year ago. But particularly with the Barclays loan I've had before, I've gone in and I've said, right, let's say for example I want a new car, I need to borrow £5,000, and actually it's affordable for me to then pay that back over 5 years. And they would do all the calculations and say, yeah, we agree, you can pay that back to us month on month on month over 5 years, and the interest rate on that will be, and then they fix it for that 5 years,
Perfect.
so that you know where you are and you know what you're going to have to afford to pay over that time.
Okay, I'm going to quickly, we've only got 5 minutes left. Alice asked the question, I think I missed it, so I'm really, really sorry, Alice.
I have Help to Buy ISA. Can I get a lifetime ISA as well?
Right, yes. So we spoke about this yesterday. So this is, if you've already got a Help to Buy ISA, can I have a lifetime ISA as well? So the answer is yes, you can have both and save into both, but the government give a 25% bonus if you save into either of them. They won't give their 25% bonus on both. You have to choose which ISA or it is that you want it on. Now, you can no longer get Help to Buy ISAs. If you opened it before November 2019, brilliant, but after that they have closed them. And into that you could put 2,400 a year. You had to do that monthly. There was no lump sums. But then when you actually use the money you've saved in a Help to Buy ISA, you then get the 25% government bonus. The difference with a lifetime ISA is that you can put in lump sums, you can put in regularly, and the government add the bonuses monthly. They don't add it at the end. So it's really up to you, and you can get more into a lifetime ISA. You can get up to £4,000 a year as opposed to 2,400. So yes, although you can have both open, you can only have that government bonus going into one or the other. And if you want to, you can transfer your Help to Buy ISA money into your lifetime ISA if you want to, up to £4,000 a year.
Alice, I hope that's answered your question. I do apologise missing your question there. Okay.
Alex has also got one on
Alex.
that topic of ISAs.
Okay, 1 second, let me try and find it. Is it in chat or question?
It's on chat.
Chat.
Bottom.
Okay. Alice said thank you. Perfect. Where are we here?
Do you qualify for the lifetime ISA if you're buying your first home but buying it with someone who already has bought their own first home?
Okay, so I looked at this a little while back. The question was, do you qualify for a lifetime ISA if you're buying your first home, but buying it with someone who has already bought their first home? Now, I believe the answer to this is, because lifetime ISAs have to be used for your first home only, up to a maximum of £450,000. If you are buying it jointly with somebody and they've already got another home, they've already had it, then you won't be able to use the lifetime ISA for that. If you were buying it in your own name and someone else was then living with you, and this was your first home, then yes, you could use that lifetime ISA, but not if you're buying it jointly with somebody who's got another home elsewhere.
Okay, we've got 2 minutes left. Rick's just told me 2 minutes left. Let's try and get everyone in here. Guys, have you seen any more that we've missed?
Yeah, on ISAs still. Haley at the top.
Haley at the top, wait there. Let's go.
Questions.
Haley, is there a similar ISA to a LISA for
the over 40s?
For the 40s, the government contributions, and which I cannot access until retirement? We had a similar one to that yesterday, didn't we?
Yeah, so because with a lifetime ISA, you have to be 39 or under to open it, unfortunately. So what Haley's asking is, if you're over 40, is there a similar thing to the lifetime ISA? Well, of course, you have got the normal ISA, which you can open at any age from age 18 upwards. And into a normal ISA, you can put up to £20,000 a year. If you've maxed that out, obviously, the most tax efficient way of saving is into your pension, because you get tax relief on the contributions, and at retirement your pot is 25% of that tax-free cash. But you must remember, if you're over 40 and you're investing in your pension, then you can't get it out till at least age 55. And that age is rising to 57 in 2028, I believe. Yeah. the similar thing to a LISA is an ISA for any of those of us that are over 40.
Say that again. The similar things between an ISA is a LISA. I like it.
A similar thing to a lifetime ISA. So lifetime ISA is for the 18 to 39-year-olds who are saving for a first house. For anybody else, if you're not saving for your first home or you're over the age of 40, then you can have a normal adult ISA.
Okay.
So that's fine.
That makes sense to me. Okay, so
Just quickly to wrap up before you go.
Wrap
any
up.
guidance on who's offering best savings accounts at the minute?
Best savings account. Oh, this is always, I love this one. Last time I looked, it was actually the government-backed provider, the National Savings and Investments, that were offering the best returns. They've got an income bond that I think is giving 1.16% return if you've got at least £500 to save, or they were offering, I think, 1% on a direct saver. But this changes all the time. There's always people coming in the market to try and give new savings. My best advice to you, and we mentioned them yesterday.
No
Sorry.
advice, it was all guidance.
My best guidance to you is
Yes.
to look at the Money Saving Expert website, because they update daily on all the best savings rates, all the best bank accounts. So have a look on there.
Okay, Sarah, that's us. We're wrapped up.
Brilliant.
Thank you to everybody joining us.
Yeah, loved it.
Oh, can I just
Really loved
say,
it.
Before we go, this is Sarah's last webinar for for pension awareness, but she's been brilliant. It's been great.
Thank you, Johnny.
We've loved you being here.
I've
Do you want to
loved
just
being
tell
here.
everyone where you're from, just so people can know and if they want to come and see you?
So when I am not an honorary pension geek, I am Sarah Steele from Better With Money, and we bring financial education into the workplace for everybody. Everybody. So
Brilliant.
look it up.
Well,
Thank you, Johnny.
I've had a great time. We've all had one last.
Next session, 2:30.
Next session, 2:30, and who's it with?
MAPS.
MAPS.
Money and Pension Service. More
Register
financial
now.
well-being. Yeah, register
Brilliant.
on. Come and see them.
See you all soon.
See you
Bye.
soon. Bye.